Over the last couple of years, something truly massive has been happening in India's financial sector. A market that was once, pretty closed off is now seeing this incredible wave of global investment. And if you're preparing for competitive exams, you absolutely have to understand this transformation. It's that important.
So here's what we're going to cover. First, we'll look at this new wave of investment itself. Then we're going to ask why. Why has India become such a magnet for all this money? We'll dig into the policy shifts that really opened the floodgates, talk about the risks involved, and then look ahead to what's next. And of course, we'll wrap it all up with the key takeaways you need for your exams. For decades, you could think of India's financial sector as a kind of fortress, super conservative, heavily protected, and really just dominated by local players. Well, the gates to that fortress are now swinging wide open, and the change is happening fast. And look, this isn't just some minor trend. We're talking about a complete reshaping of the entire landscape. This sector, which was so tightly controlled, is now seeing a flood of global money. Financial giants from all over the world are done just watching from the sidelines. They are now jumping in and buying up major stakes in India's top financial institutions. And the sheer scale of these deals is just staggering. We're talking about huge global players like Blackstone from the US, Emirates MBD from the UAE, Zurich from Switzerland, and SMBC from Japan. They're pouring billions and billions of dollars in, and they're not just buying small shares, they're acquiring significant, sometimes even controlling, stakes in major Indian banks and insurance companies. So that brings up the big question. Why is all of this happening right now? This kind of money doesn't just show up for no reason. What are the key pull factors that are making India such an irresistible magnet for global capital? Well, the first and probably the biggest reason is just pure performance. India's banking sector pulled in a mind-boggling $46 billion in net income this year. That's a growth of 31% from the year before. I mean, that kind of profitability is incredibly hard to find, especially when other big markets are slowing down. And just to put that growth into perspective for you, take a look at this. While banking revenue in developed markets like the US and Europe is pretty much flat, the outlook for India is incredibly healthy. Global investors see a straight line to strong returns here that just doesn't really exist anywhere else right now. And this growth is built on some really solid foundations. For starters, you've got massive demand for credit from small businesses and regular consumers. Then there's this huge untapped market of 400 million people who are still underbanked. On top of that, Indian companies have been deleveraging, which is a key term. It just means they've been busy paying down their debt, making them much healthier financially. All this is happening in an economy that's incredibly resilient, with the RBI predicting 6.8% GDP growth. And finally, let's be honest, with all the risks around China, India is looking like a very stable and natural alternative for that global money. Okay, for all of you studying for exams, here's a handy little memory trick to remember some of these big investors. Just think of the headline: Big Zebras Sprint East. That'll help you remember Blackstone, Zurich, SMBC, and Emirates NBD. A super simple way to keep the major players straight in your head. But, a strong market is only half the story. The real catalyst, the thing that really gave the green light for this tidal wave of investment, has been a major shift in government policy and regulation. The real game changer here has been the government easing up on the rules for foreign direct investment, or FDI. Before, foreign ownership was really limited, but now, those limits have been relaxed in a big way. The cap in private banks has jumped up to 74%, and for insurance companies, it's all the way up to 100%. The regulators have basically rolled out the welcome mat. And as Rennie Thomas from McKinsey points out here, even with all this incredible growth, India's financial penetration is still way behind most other markets. And that's not a bad thing. It's actually a huge opportunity. It signals to investors that this growth story has a very, very long way to go. But this flood of capital isn't just a one-way street of good news. It brings a whole new set of complicated risks that regulators have to manage very carefully. It's a really delicate balancing act between grabbing the opportunity and maintaining stability. So what's the catch, right? What are the possible downsides to this global gold rush? Let's break down the main concerns that policymakers are keeping a very close eye on. We can basically group the biggest risks into three buckets. First, there's the loss of strategic control. What if the big decisions start getting made overseas? Second, there's a bigger vulnerability to global shocks. A crisis somewhere else in the world could hit India much harder now. And third, you've got the risk of a distorted playing field, where foreign companies with cheaper funding could squeeze out local players.
Hey, for your exam notes, here's an easy way to remember this. CSD, control, shocks, and distortion.
This is exactly where India's regulators like the RBI and SEBI come into play. They're being proactive, but also very cautious. They're making sure everyone follows strict domestic rules. One of their key tools is enforcing capital adequacy norms. It's a fancy term, but it just means they force banks to keep a certain amount of cash in reserve, like a safety cushion to handle any unexpected problems. The goal is simple: welcome the investment, but make sure the whole system stays stable. So, when you put it all together, what does this mean for the future? Well, this trend is so much more than just about making a quick buck. It's a long-term, strategic bet on the future of India's entire economy. India has a massive goal to become a $7 trillion economy by the early 2030s. To get there, you need a tremendous amount of capital. This wave of global investment isn't just a nice bonus, it's the essential fuel that's needed to power that economic engine and hit that target. So really, the ultimate test for India is to manage all this incoming money strategically. The challenge is to make sure it strengthens the country's financial independence and stability, instead of accidentally weakening it. It's a historic opportunity for sure, but one that requires some very, very careful steering. Okay, now for all of you preparing for your exams, this is it. This is your comprehensive revision guide. So get ready to take some notes, maybe even pause after this, because we are going to lock in the absolute most critical points from everything we've talked about. All right, let's run through these key takeaways quickly. First, you absolutely need to know these major deals, the investors, and who they invested in. Next, lock in these key data points, that $46 billion in income, the $400 million underbanked, and the 6.8% GDP growth estimate. The updated FDI limits for banks at 74% and insurance at 100% are crucial. Make sure you can list the main investment drivers and define those core concepts like deleveraging. And finally, be ready to explain the 3 key risks: control, shocks, and distortion. And we'll leave you with this one final big question to think about. As all this global capital continues to reshape India's financial world, how can the nation strike that perfect balance, leveraging this historic opportunity for growth while at the same time protecting its own long-term economic independence?